There's a huge problem with the 401ks our employers offer us that's most likely affecting 90% of you watching this. But since you only have access to the investment options in your 401k, it might not be as obvious of an issue. In this video, I'm going to uncover an enormous flaw that I discovered while reviewing my 401k that's most likely affecting you. And then I'll show you how to avoid the problem altogether. The result of not being aware of this sort of thing could come in the form of forcing you to have to retire a few years later than you actually have to. Unfortunately, my ex-employer, Goodyear, is going to be the poster child for what's wrong with 401ks across the United States. Yes, I'm going to call out Goodyear specifically because I think that what they're doing is wrong. Plus, I don't work for them any longer, so what are they going to do, fire me? I need to call something out real quick about Goodyear so that no one gets my intentions twisted. We need to separate what they're doing with their 401k from them as a business and employer. I have nothing but great things to say about working for them from an employee perspective. I worked with some pretty awesome people over there and they treated me very, very well. I also plan to be a lifelong customer of theirs because after working behind the scenes, I can confidently say that they have some of the best tires on the market. What I do think they and other employers need to be criticized for is the poor position they're putting their employees in when it comes to investing for their future. The reason I can confidently say that this could be impacting 90% of you is because I looked at my 401k investment options and reached out to 9 other individuals to get a list of the options their employers were offering them as well. I'll admit that it's not the largest sample size, but it's enough to notice that it wasn't just an issue within my 401k. From there, I combined all the data into a spreadsheet to look for trends, and boy, was I extremely disappointed. To be fair to the people who shared this info with me privately, I'm going to avoid calling out who they work for because I don't want to put any of them in a difficult position with their employer. To understand the glaring issue, you first need to understand how the fees work for the investment options within your 401k. You'd be surprised how many people don't actually understand this, and it's not really their fault. Every fund offered to you has a specific expense associated with it, which is usually referred to as an expense ratio. This expense ratio is paid to the company who manages that particular fund. Now, there can be many different funds managed by many different companies within a 401k. For example, Goodyear offers an international fund managed by JP Morgan where they charge 0.57% when you own that investment. This is considered an actively managed fund where the fund manager is going out and actively picking stocks to buy and sell on a regular basis. You can tell this is an actively managed fund by either doing a quick Google search to read about their investment process, or it's pretty easy to spot based on the high 0.57% expense that they're charging. I know 0.57% doesn't seem like a lot, but I'll do some quick math in a minute to show you the dollar amount it costs to own this fund. On the other hand, someone shared with me an international index within their 401k that's managed by State Street, where the cost to own that fund is 0.07%. Because the name says index and the expense is very low at 0.07%, we can tell that this fund is passively managed. In this case, there is a fund manager who runs this index fund, but they're only buying and selling stocks based on the underlying index and not actively trying to pick stocks on their own like an actively managed fund would. Let's compare the actively managed fund with the passively managed fund to see the true cost in dollars. If we invested $10,000 into the actively managed international fund offered by JP Morgan with a cost of 0.57%, then at an average annual return of 7% over 30 years, you'd pay a total of $11,270 in fees. If you invested that same $10,000 into something like the passively managed international index offered by State Street with a cost of 0.07%, then after 30 years, you'd pay a total of $1,626 in fees. The actively managed fund is 7 times more expensive, but I need to call out that just because something is lower cost doesn't always mean that it's a better choice. The cost is only one data point that we can use to understand if we should be investing in an actively managed fund or a passively managed index fund. So then I wonder if there's a way to find out how actively managed funds perform compared to a low-cost index fund. That was a stupid question since I know the answer, because the good news is that there is. The S&P Dow Jones Indices releases a yearly scorecard that tells us the percent of actively managed funds that underperform their underlying index. Over a 3-year period, 66% of actively managed international funds underperform. Over a 10-year period, 80% underperform. And over a 20-year period, 91% of actively managed funds underperform a basic, low-cost, passively managed index fund. Are you starting to notice a trend? The further in time that we go out, the more likely it is that an actively managed fund will underperform a basic, low-cost index fund. because it's nearly impossible to do so. This is also the case with total US stock index funds, where 88% of active funds underperform. Same with large cap funds, where 94% of actively managed funds underperform. Mid cap funds, where 91% of actively managed funds underperform. And of course, small cap funds, where 94% of actively managed funds underperform. The moral of the story is that you're better off investing in a low-cost, passively managed fund over any sort of actively managed fund every single time without question. This brings us to the first issue. In a lot of the 401ks that I reviewed, there are more actively managed funds than there are low-cost, passively managed index funds. Luckily, every 401k has multiple target date funds, which are usually low cost, but I'm basically considering all of them as one within each 401k because they're essentially the same thing, just with different dates. This means that if your 401k investment options look anything like Goodyear's, then you have 3 passively managed funds and 6 actively managed investment funds to choose from. I don't know about you, but something just seems wrong about that. We'll cover what you can do about it in just a minute. Please do my dog Molly a huge favor and hit that thumbs up button, because she would love you long time. Our employers choose the investments that are available for us to invest in, so it's not like this sort of thing can't be avoided, especially with huge companies like a Goodyear that employ around 75,000 people. Having an outsized amount of actively managed funds makes it absolutely impossible to build a low-cost, diversified portfolio within a lot of 401ks. Even though the data is absolutely conclusive that those expensive funds just do not perform well over the long term. By diversified, I mean something like a solid 2 or 3 fund portfolio. I made a whole video on the benefits of a 3 fund portfolio, which I'll link up down in the description and at the end of this video if you want to check it out. It's essentially where you only invest in 3 asset classes to keep costs low and to diversify yourself as well. To be clear, I'm not saying that there should be 0 actively managed funds offered within a 401k. I am all for a free market and competition. So if JP Morgan wants to offer an expensive, actively managed international fund, then that is their right to do so. But at the very least, for every expensive, actively managed fund offered within a specific asset class, our employer should offer an equivalent low-cost index fund option as well. By offering less low-cost options, it forces people like you and me to be less diversified in our investments, which can open the door to even more investment risk. In the case of Goodyear's 401k offerings, if you want to keep costs low, then you're essentially forced to either invest in only an S&P 500 index fund or a target date fund. And I made a whole video about the flaws associated with a target date fund, which I'll link up down in the description and at the end of this video as well. The next problem is that your hands are tied with your current 401k to where you are just stuck there. You can't opt out and move to a different 401k until you quit that job. It is the only game in town, so you can only invest in what's put in front of you, which is absolutely messed up. Kind of reminds me of I don't know, what's the word? Monopoly, which is pretty illegal in the United States, but of course, our employers can get away with it within our 401ks. Okay, enough negative stuff. Let's go over some solutions I have to this problem. Then I'll share a handful of the worst funds within the 401ks that I reviewed, because personally, I think that a few of these fund companies just need called out. The first solution might be a long shot, but it's worth a try. An option would be to reach out to your HR department or benefits department to see if there's any way for them to add a low-cost, passively managed index fund for each investment class. If you do this and need some help, this is exactly what you put in front of them. The funds that you'd want are an S&P 500 index or total stock market index that are comparable to the ticker symbols VTSAX and VFIAX. You'd also want a total international stock index fund that is comparable to VTIAX. And you'd want a total bond market index fund that is comparable to VBTLX. Some additional nice to have options would be a REIT, mid-cap, and small-cap index fund as well. At the very least, try to focus on the first 3 that I gave you. The key is for them to give you options where the expense ratio is no more than 0.10% at the most. Any more than that, and you're just getting ripped off. The reason you might not have these low-cost options available to you right now is because your employer may have just been sold really, really hard on the current options by some scummy salesperson in the financial industry. Another reason is that leadership within the company might just be very uneducated on the topic. But I think it's some point, our employers need to be held to a higher standard with this, and we can't just let them claim, "Oh my goodness, I had no idea." I'm gonna call on that one. There could also be some behind the scenes dealings where someone somewhere is getting a kickback to put these specific investment products in front of you. Is having horrible investment options within your 401k illegal? It can be, but as long as they offer a few very low-cost, passively managed funds, they can probably get away with it. I think that's why we see so many target date funds within a 401k, because I have a feeling that each one of those counts as a quote-unquote low-cost fund. At the very least, it's immoral and unethical for your employer to offer high fees within a 401k and very few low-cost options. Which is funny because, I don't know about you, but back when I worked at Goodyear, we had to do ethics training every single year. Maybe leadership within the company should take some ethics training before choosing the investment options within their employees' 401ks. Psh. There's Jarrad talking crazy again. The second thing that you can do to avoid investing in high-fee, actively managed funds is to only hold the low-cost options within your 401k, and anything else you want to invest in can be put into other retirement accounts. One thing I noticed across the board is that all of the 401ks I reviewed had a low-cost S&P 500 index, which is great. But going back to the whole three-fund portfolio talk, if you wanted to invest in international or bonds as well, then the high-fee options were all that you had available to you in that 401k. If this was the case and you still wanted to invest in these three types of assets, then you could hold all of your S&P 500 allocation within the 401k because it had the lowest cost. Then you could use your other retirement accounts like an IRA, or if your spouse has a 401k with low cost options, to invest in an international and or bond index. For me, that's what I'm going to do. Since Goodyear's 401k investment options are absolutely trash, I'm going to invest all of the money within that account in the S&P 500 index. With my international index fund investment, I'm going to hold some of that in my Roth IRA, as well as another 401k with another previous employer where they offer a low cost option as well. One of the grossest investments that I saw within a 401k was the target date fund that JP Morgan was offering one employer. To give you context, the average cost of a Vanguard target date fund within the 401ks that I came across were 0.045%. This would equate to a cost of a little over $1,000 over 30 years at a 7% return. JP Morgan was offering a target date fund for 0.88%, which is absolutely mind-blowing. That is over 19 times more expensive than the Vanguard option, and it would cost the investor $16,700 versus $1,000. I'm reviewing this video that you're watching right now, and just seeing those numbers again of how much JP Morgan is charging for a stinking target date fund is disgusting. It is messed up that they can actually get away with that. And on top of that, that our employers actually put this trash in our 401ks for us to eventually or potentially invest in. It's not right. All right, back to the video. Templeton Global was charging 0.69% for a bond fund, which would be 17 times more expensive for a cost of $13,400. JP Morgan was charging 0.57% for an international fund, which is with Goodyear, which would be 7 times more expensive for a cost of over $11,000. Fidelity was charging 0.69% for a large cap fund, which would be over 21 times more expensive for a cost of $16,300. I could go on and on with more examples, but I'm going to stop there. Don't forget to hit that thumbs up button, please. Check out the description down below to join the private financial independence group and get some free stocks as well. I'll see you in the next one, friends. Done.